All right, let's get started here. Thanks everybody for joining us today. We got a lot to cover here. I'm joined by Josh Howes, who is the CEO here at Walker Blue, and John Capperell, who's our Senior Director of Renewable Energy Tax Incentives. They got a riveting topic to discuss about solar safe harbors. I know we've been getting tons and tons of questions on the solar safe harbor from our clients, our ESCO partners, our CPA partners. I'm excited to have them kind of bring this up. And there's been a little bit of a court ruling here that happened recently, so there'll be a lot to go over. With that being said, I'm going to turn it over to Josh and John, and look forward. Oh, sorry, forgot to mention. If you do have questions, I'm going to ask you to drop them into the question and answer box that should be at the bottom of your docket or under the more um, deal. So you can go to the QA, drop them in there. I'll be monitoring those, and then we'll get to them at the end of the presentation. So that being said, I'm going to turn it over to Josh Howes and John Capperell. Appreciate everybody joining us. Thank you.
Hey everyone, thanks for joining us. So we're going to jump in. Basically, the the service lines that we cover on the next slide. There you go. So basically, here at Walker Blue, we've been covering 179D almost since the very beginning. Back in 2009-10 range is when we started on 179D. Um, Hopefully, that will get extended here soon, but that's a topic for another webinar. Energy tax credits, we've been focusing on those for the last 4 or 5 years, particularly Section 48 and 48E, but we also handle 45 and 45Y. Inside of both of those, but inside of both of 179D and the ITC, PTC is prevailing wage and apprenticeship requirements. So we certainly have embraced the PWA requirements. We not only can do an analysis, but we can monitor your projects from start to finish, from collecting the wage reports, doing the apprenticeship analysis, helping you with apprenticeship programs, things of that nature. And then domestic content as well. So with the ITC, there's a domestic content provision. So we handle that analysis, handle dealing with the suppliers and the equipment manufacturers on both domestic content and FIOC. We do the macro analysis, and we have a residential division as well. So Section 45L, it's also expiring, but we can do legacy projects. If it gets renewed, we'll be here. We're Energy Star compliant with all of our inspectors. And so we can do Energy Star compliance projects. We can do lead modeling and things of that nature. So we're kind of a specialty tax firm. But today, obviously, our topic is beginning of construction, which is for most of us, we're going to be talking about the solar. We're going to kind of be directing it towards you solar folks who have a deadline coming up with July 4th on getting your project placed into service in order to safe harbor it. 179D is also, a viable reason to get your project started. That has to be under construction by June 30th. So we're gonna dive into what start of construction looks like, what it means, how to do it, what the recent ruling on Saturday means for all of us. But for like I said, for the most part, we're going to be focusing our efforts today towards Section 48E and the solar impact on the beginning of construction safe harbor. So next slide. What is Section 48E? So most of us know that's the new section that was created out of the Inflation Reduction Act, where Section 48 was replaced with 48E. It's basically the same. It's very similar to the old Section 48. The big change was that it's tech neutral. So all these new technologies that are coming online are eligible as long as they have zero greenhouse gas emissions. So that's basically anything that produces electricity that has zero greenhouse gas emissions is eligible for a Section 48E ITC. The Big Beautiful Bill was enacted in 2025, which sunsetted a couple of these technologies, particularly solar and wind. We have two deadlines that we're concerned about. The first one is coming up here in less than a month, which is the construction start deadline. So if you want to be eligible for the Section 48E ITC, you need to get your project under construction by July 4th. If you do, then you are basically open-ended. You don't have to have it completed by any particular deadline because you met the start of construction deadline. If you fail to get it under construction by July 4th, you have another deadline that you can still get in under and be eligible for the ITC, which would be the placed in service deadline, which is December 31st of 2027. So not all is lost if we don't get under construction by July 4th. If you think that you can get completed by December 31st of next year, then that project's still going to be eligible for ITC. Of course, project delays and things of that nature can affect that deadline. So it's a little bit more risk going in if you miss the deadline here on July 4th, but not all is lost. It's either or. It's not a both. So that's how we view the one big beautiful bill. So in light of that, we'll jump into the executive order. Yep. So John, you want to take over from here?
Yes, thanks, Josh. And again, hello, everyone. Nice to have you with us here today. Very topical issue, not just because of the looming deadline coming up next month, but we had some activity, some important news over the weekend, which is unusual in itself, and we'll talk about that a little bit as we go. This was the Oregon Environmental Council case that essentially had a major impact on what we're going to discuss today, with an asterisk, and we'll get into what we mean by that. So, from the budget bill from last year, if you recall, July last year, there were changes to the IRA, to the energy provisions of IRA, specifically relating to solar and wind. We're going to talk about solar here today. We're going to focus on solar. But if any of you are involved in wind projects, most of this will be applicable to that as well. And so what this did was as Josh just explained, it shortened up your placed in service date to 12/31/27, the end of next year. Sounds like a long time away, but in projects of this nature, it's permitting, construction delays, supply chain issues. That year and a half can deplete very quickly, and so this is a real deadline, something to be concerned about. Alternatively, there was an executive order related to the budget bill that said there will be issued guidelines from Treasury, IRS, that will allow taxpayers to have a structure for how to qualify for a potential additional extension of time, and that can be up to as long as 4 years, 4 calendar years following the year that you begin your construction. For instance, if you begin construction at the end of 2025, you will have until 12/31/29 to place your project in service. If you are under the gun and just coming in on beginning your construction by July 4th of next month, then you'll have until 12/31/2030 to place your project in service. And this came from what is called Notice 2025-42, which is the promulgation of the OBBB interpretations and the executive order that followed to provide these guidelines. Now, the question is 2025-42, that's the intended topic for today's discussion. there were some elements of that that are particularly important to just keep in mind. The major change in the safe harboring, or in the beginning of construction rules, I should say, is the relegation to now the physical work test as the primary source of qualifying for demonstrating you've begun construction on your project. Meaning there was a 5% safe harbor that was used widely, that did go away for larger projects. It's still available for a project up to 1.5 megawatts output. This is a solar or wind project, a solar project in this case, rather. It's not available for wind. And so the thing that happened Saturday, and Josh, maybe we could go to the next slide, is we woke up, or not woke up, we ended our day with this published opinion from DC Circuit, and it said that this order is going to vacate Notice 2025-42. Now that sounds fairly dramatic, and it is, no doubt. However, the way the order was written, there's a feature in it that was a remand. A remand, not to get into the procedural aspects here, but a remand means the Notice 2025-42 goes back to IRS, and they get a do-over. They get another shot at getting it right based on this case. IRS also has other recourse. We're not going to get in. That's not what this call is about. This webinar is about. But we just wanted to share that with you, to at least so you understood, from our perspective, 2025-42, which are the guidelines for how to implement the beginning of construction rules for solar and wind at this time, is temporarily suspended. We don't know what it's going to look like when the litigation winds out. We don't know when that's going to happen. And so we are going to share with you what we can about how these rules are going to work, how you can apply them to your advantage, and at least how to understand them. And so this is how we are approaching this, and this is our internal work that we've done, evaluating the various alternatives. And first, we're going to recommend that if you were working to qualify your project under the physical work test, continue that process. Do not suspend that process. Continue that process, because we simply do not know how this is going to resolve. And so that would be our first recommendation. Second recommendation: if it's practicable, meaning if it can be done, it would be in your interest to try and also meet the 5% safe harbor test, regardless of the size of your project. And what this means is, if 5% of your total qualified project expenditure is made by July 4th of next month, July 4th, you can be deemed to be meeting the safe harbor and get one of those extended placed in service dates, either 2029 or 2030. Now, the importance of that isn't to shift or pivot over to that test. Actually, it's a safe harbor versus a test, but to give it to you as a potential backstop. The problem with the physical work test is it's somewhat subjective. It's facts and circumstances. IRS would challenge, and you would be required to demonstrate compliance. And so the nice part about a safe harbor is you meet that bar, you cross that threshold, and they essentially will leave you alone, provided you qualified to the extent of what kind of things you bought, what kind of things you spent money on or incurred costs. So that's the advantage. If it's a belt and suspenders, we like it, and that's the one advantage you can take away. Third, if you're a low output solar facility project, do not pivot entirely to the 5% safe harbor. If you can meet the physical work test, it's good to do both. But chances are you're going to be in the best shape, because there would at least we'd expect the low output solar facility 5% safe harbor will survive. Okay, next slide, please, Josh. All right, so and this just describes that, and these are takeaway slides for you, so you better understand a little bit about what happened and what the practical takeaway is. Bottom line, advance the physical work test where feasible, keep going, but if feasible, rather, document a 5% safe harbor as your backstop. That's probably your best situation. Okay, next slide, Josh.
Yep. Thanks, John. So I'll add a little bit to that and maybe a scenario that you didn't cover. If you are over a 1.5 megawatt output and you cannot meet the physical work test, you certainly can go ahead and try to uh, get your 5% safe harbor done. If that's a reasonable thing for you to do, and you're going to move forward with the project with or without the ITC, without this safe harbor being in play, then you should document the 5% safe harbor and get that done by July 4th. But again, it's not going to be like John said, it's not something that we feel like is a reliable way to start your project. We think at some point the IRS is going to put in some form or fashion the notice that omits the 5% safe harbor from the 1.5 megawatt output, but you never know. So it could be something that you can get established if you're moving forward anyway, and you'll have that documentation if in the end this ruling holds up, that you have now actually got a start of construction before July 4th. And now that kind of relieves you from that 2027 deadline that you're probably shooting towards, because you're going to miss the physical work test of starting construction for July 4th. So just a little caveat there. So we've kind of talked a lot about these things. So what do they actually mean? What does it mean to start physical work, and what is the 5% safe harbor? So these are the two ways that you can actually start construction according to the IRS. These are tried and true methods. They've been around for 13 years, I think, since the 2013 guidance that came out. So let's walk through each one of these two scenarios real quick. It's the next slide. So physical work test. This is obviously our tried and true method. This is the one that applies for all solar projects of all sizes. Both over and under 1.5 megawatts can do this method to get started. What we want to highlight on this is that beginning physical work means work of a significant nature. That's the language that's used in the IRS language. So significant nature isn't mowing the grass. It isn't mobilization. It isn't even clearing bushes. That's not significant work. Typically, when we look for significant work, we're looking to put something in the ground, not remove something. So things like demo, things like mobilization, moving equipment around, putting people on site to clear. Those are not work of significant nature. And the IRS, in some of their notices, has even specified a lot of those particular activities as not qualifying for physical work of a significant nature. What does qualify, examples of things that do qualify are on site, if you can start laying your foundation. If you've got footers to put in, if you've got piers to put in, if you've got wells to drill, those types of work do qualify as work of a significant nature. From the solar standpoint, if you're on a roof and you can start mounting your racking system and start putting those types of structures in, those will qualify. And then obviously, like building roads. So you're constructing something again. So if we can build an access road, that's going to qualify as work of significant nature. How much work is significant? That is open to interpretation. Can you put one peer in and qualify, or should you put 100 peers in and qualify? Obviously, the more the better. That's our advice. But you need to be doing something constructive, not something destructive, from our perspective. The other way is offsite. So we have a lot of projects that have been getting under construction by doing offsite physical work. Your manufacturer of your components for your project, they can begin manufacturing your equipment and your materials, and that will count towards starting construction. We like to basically, not just us, but according to the IRS, it needs to be components that can be tied to your project. So it needs to be somewhat custom in nature, because it can't be something that's just off the shelf. So, if you have, if you're using solar panels that could be used on 100 different projects, well, that's not specific to your project to document that that solar panel is being manufactured. But if it's a racking system that can only be used on your project, and if you were to default on that payment, they would have nothing to do with that racking system because nobody else can use it. That makes it somewhat custom in nature, and that can be specifically tied to your project. And so those are the types of offsite manufacturing that we're going to be looking for to help you start physical construction offsite. Next. So the 5% safe harbor, that's for those of us that are under a megawatt and a half. This is still eligible. And again, if you're over a megawatt and a half, this is also a belt and suspenders. This is another potential avenue to get your project under construction safely, because it's a little bit less subjective. Because, like we talked about, how much work is significant on site? Well, that's open to interpretation. Is your manufacturer actually manufacturing a component that's custom enough in nature to qualify as physical work? So those are somewhat subjective. We can try to hone those in and make those as tight as possible, but there still have some subjectivity to it. 5%, that's a hard number. So it's a lot more. It's a lot less risky to say, well, my project's $1 million and I've put 50,000 towards this. So, or that's 5%. So that's a pretty easy calculation to make, right? So there's two different ways to do a 5% safe harbor. Depends on the taxpayer. So all these are from the perspective of the taxpayer. So the taxpayer is the one who's receiving the tax credit. This is the one who needs to be making the 5% payment. So you can either do that with cash, or you can do it with an accrued expense. And that's going to depend on how your accounting method is set up. So if you're on a cash basis, then you have to pay cash out for the 5%. If you are on an accrual basis, you can incur an expense. And as long as that, which we're going to get into, I think, on another slide, but as long as that, as long as that is how your accounting method is done, and you can show that you've incurred that expense as an organization, then that's another way to start your 5%. So it's all going to be dependent on your established accounting method. But real simply, what I want to highlight on this slide is that 5% is going to be from the perspective, like I said, of the taxpayer who's receiving the tax credit. And it's also going to be done from the perspective of once the tax credit's claimed. So at the end of the project. So if you think it's $1 million project and you put down $50,000 and it ends up being a $2 million project when it's all said and done, you did not meet the 5% because you only put down $50,000. So you have to anticipate construction costs going up. So we encourage you to put down 7, 8, 10% towards your 5% safe harbor, because things happen. And when those things happen, you want to make sure that what you incurred in your expenses prior to construction to establish that start of construction covers you in the end if your costs were to go up. So we're going to go through on these next few slides, I think, 5 different ways of paying the 5% and 5 different structures, so to speak. So the easy one is cash. This one's a no doubter, and it doesn't matter if you've got a cash basis accounting method or an accrual basis accounting method, or if you've got whatever your structure is. Cash always works. So the safest way to start construction and put that 5% down is through an actual payment of cash. So real simply, if you, depending on whether you're ordering equipment or if you're ordering materials or if you're paying a contractor a deposit, the 5% cash always works. It needs to be non-refundable, which basically means that you've committed to the purchase. And the way I like to explain this is if you have to keep in mind this is kind of an exception to the physical work test rule. This is kind of a second way that the IRS has given us to start construction. So if you think of a physical work of some physical work of a significant nature, you're going to be going in and say you're going to pour your foundation. Well, you've pretty well committed to that project, and if you decide to bail out of that project, you're not getting that foundation back. It's done. It's in the ground. So the IRS wants to see something similar when you pay that 5%. They want that 5% to be in the ground. They want it done. It's not refundable. You can't get it back. It's a commitment to start the project. So whether you're ordering equipment or you're putting a down payment with a contractor, it needs to be surrounded by language with that payment that says something in nature that this is not refundable. This is a commitment. You can't get it back. You can't cancel. This is a payment that's it's done. So a non-refundable deposit of some sort that locks you in. And then the delivery rule, we get a lot of questions on that, and then we'll go to the next slide. So if you order equipment and we get the question, do you have to take delivery on that equipment? Can it be stored in an offsite warehouse? Can it still be being manufactured? The rule of thumb is 3.5 months for the IRS. So if you order something and it's a reasonable expectation that you're going to get that equipment delivered within 3.5 months, it's as good as if it was delivered. So that's the bar that we have to meet. If you order something and you know it's a year off before you're ever going to see it, that's not going to count towards your 5%. It needs to be something that you can reasonably expect to have delivered in 3.5 months. All right. And then the next slide. So I'll cover this one and then we'll let John take over. So where are we at? Go back to the prepaid equipment agreements for me. Back one. There we go. So prepaid equipment agreements, I've kind of touched on it a little bit. If you're going to be ordering equipment as your 5%, it's totally legitimate. You have a contract with, say, a racking manufacturer who's going to build your racking system, and you're going to order that. Or if you've got panels that you're going to order, whatever it is that you're ordering, if you have an equipment agreement that says you're going to give me X amount of dollars as a deposit or as payment in full, this is a binding agreement. It's not going to be refunded in any way. Then you can prepay those equipment. You can prepay those equipment manufacturers, and you can establish that 5%. And again, I mentioned the 3.5 months. That's the expectation. The 100-day rule, where you can reasonably believe that you're going to have that equipment delivered, that is kind of our bar. So whether it's a solar panel, whether it's custom, it doesn't matter. As long as it's non-refundable and reasonably delivered in 3.5 months, prepaid equipment agreement is a perfectly acceptable way to establish 5% start of construction. John, I'll let you take it from here.
All right. So, and again, let me just frame this a little bit for our accountants in the group. This payment process how do we count it? When do we count it? It really comes from Section 461 and the all events test, things you're familiar with. One, in the all events test, you know how that works, is you establish there's a liability. There's a legal liability. Josh talked about the contracts, the signed contracts. Two, you've got the ability to value that purchase or expenditure. That also is related to the contracts. Third, this is the one that can be overlooked, economic performance. Now, economic performance is when the services or goods are provided. That's when you've got the economic performance, the recognition of a deduction, and all of that. IRS allows this special rule of 3.5 months after payment by an accrual taxpayer, and to be able to get credit for that for these purposes. But the goods have to be delivered, the services have to be delivered within that 3.5 months. So that's where that comes from. So in vendor financing agreements, the same rules apply. And so whether it's when you've got the recognition of the liability, the determination of the liability, and then it's the economic performance of that liability that gives you the ability to count that towards your 5% required spend. Then one of the things that's related, it's a related issue. If you're doing a financing through a lease, you want to make sure that it's a capital lease if you're looking to be the owner of the property. That's something that you often see is capital lease versus operating leases. If you're purchasing something through a lease transaction, you want to be assured that it's a capital lease so that you can count that as your asset, your depreciable asset, and your expenditure. Next slide, please. Turnkey EPC agreements. This is now you're working with a developer. And the developer is working with the engineering firm, procurement folks, construction people, and putting this project together. So if you make your 5% payment for simplicity to this EPC, you want to have some assurance that they're in turn spending or incurring costs related to that 5% downstream. And again, that gives us comfort and assurance that we see that all the way through as paid or incurred. Next slide, please. Lease to own. This now goes back to this idea of what kind of a lease do we need, things like that. So this is a situation where you as a business owner may be leasing to own. And so when that's the case, you're going to want to, again, have this to be deemed a capital lease so that you can take the credit. If it is an in-process project and you can get under the July 4th deadline and you have to make advance payments either as deposits or advance lease payments, those may count also towards your 5% case by case. But again, this is just to demonstrate to you there's some flexibility in this structuring that we can evaluate and help you determine whether you qualify or not. But again, time is running short. Next slide, please.
Yep, I'll jump in on the continuity requirements. Yep, so the continuity requirement is another question that we get a lot about. Like, if we get under construction by July 4th, how long do we have to complete it? Well, in theory, you have as long as it takes. However, you have to show continuous effort, right? You have to be continuously under construction. So the nice thing about what the IRS has done is that they've given us a essentially 4-year window where they're not going to ask any questions. So like John said at the very beginning, if you get your project started this month, this is June of 2026, you have until the end of the year, 4 years down the road to complete your project. and you'll be underneath this continuity requirement safe harbor that the IRS has given us. So that gives you until the end of 2030 to complete your project. You can go beyond that and still be eligible for the ITC, but now you're into a facts and circumstance issue. So now, if the IRS was to come and question your continuity, you would have to prove that you were continuously under construction from the start of construction date all the way to the completion date. You don't have to necessarily be continuously under construction, but if you have gaps in your construction, you have to have an excusable delay. Um, Weather, supply chain issues, and those have to be documented and they have to be acceptable excuses for the IRS to allow that gap in construction. If you have a gap in construction because you had other things, you had another project you had to tend to, for instance, and your contractor missed a month, that could create a situation where you completely lose your start of construction date and it gets reset back to that date and you've lost your ITC. So we definitely want to encourage the 4-year safe harbor. Again, it's a no questions asked type issue with the IRS. So you want to avoid the facts and circumstances issues. So by all means, try to get completed within 4 years. But if you don't, there's companies like ours that'll help you document, prove it out, prove your delays were excusable, and try to help you make a case, your a facts and circumstances case that you've met your continuity requirement. This is critical because it is a requirement. So if you think there's a possibility of your project going beyond the 4-year safe harbor, you want to be documenting all of your delays and all of your reasons for those delays all along the way. Because if you get into the facts and circumstances test, it's going to be really hard to think back 3 years ago and pull up that documentation of why did we miss a week on the project. And it's all going to be scrutinized by the IRS if you were to be audited. So this is a really important topic, and it's one that we don't want to overlook. What's next? John, I'll let you take this one.
All right. So there are a couple of nuances that we're going to want to explain to you a little bit because they sound similar, but there are differences. And first of these is the relocation rule. The relocation rule works this way. Let's say that you're a school system and you're developing a solar project in your school district, and you've begun construction, you bought equipment, it's going to be meet the low output solar facility requirements, and but you find that partially through the process you need to resite this facility for some reason because you're moving the equipment that's already been partially constructed, perhaps even designed, developed. You want to know if you could take those costs and include them in the BOC, the beginning of construction requirements. In most cases, that would be yes, and that's because it's the same owner, and you are, as the owner, allowed to relocate those physical assets between different locations and grandfather the beginning of construction time that you'd spent. And so there are an array of alternatives here. First is your placed in service date. If you are able to meet your placed in service date of 12/31/27, that is your least risk, your lowest risk, you're going to qualify. That's not going to be an issue. If you're relying on the physical work test, if, for instance, in a larger project than a low output solar facility, you still carry that low risk because, but it's still going to be subject to that additional scrutiny, facts and circumstances analysis of using the physical work test that Josh mentioned. So there's risk, but it's still low. The third alternative, and this is where it gets a little bit interesting. This rule, the 5% rule, the reason we say that it's generally allowable, that's our position, is that in the low output solar facility projects, the rule changed slightly in this new notice from the prior notice, and it struck the phrase 5% safe harbor from the language. And when you read something like that, it sounds as if that's not going to be an allowable beginning of construction way to meet your beginning of construction rules. However, the language also mentions amounts paid or incurred. And so by striking that phrase, 5% safe harbor, but still referring to paid or incurred, in our interpretation, that means that this 5% safe harbor rule will apply in cases where you're relocating assets from different school buildings that are owned by the same school district. It's not an absolute answer, and that's why we say there's some risk, and it is one of the nuances we picked up between the prior notices and the current notice that right now is presently suspended. If that wasn't complicated enough, so I apologize for that, but that's welcome to our world. Josh?
Yep. The next slide. So, like transferring to a different site, you can transfer to a different owner. So how that would apply is that if you, if entity number one starts construction on this project and they meet the safe harbor start of construction, whether it's a physical work test or the 5%, depending on project size, and then that entity wants to hand off or sell the project to a second entity while we're during construction, that can be done and preserve the beginning of construction that was already established by the first owner. So we'll kind of walk through that, but the caveat, the overlying and advice, I guess, or the overlying method that we prefer, that's the least risky, is that you don't transfer the property. You're not selling the property, so to speak. You're selling the entity. So we want to see some sort of special purpose entity created so that that entity is completely being sold, not the property being sold. So the first three, we'll go through the same three scenarios that John went through on the last slide. Obviously, the first thing is that we're going to be placing it in service by the end of 2027. If you have this transfer, it doesn't matter how you do it. You can transfer the property or you can transfer the entity, but it's all either way. We're completing construction by the end of 2027. So the new entity that owns all of those assets places those in service by the end of 2027. There's no risk in that because we're not relying on a beginning of construction date that we're trying to protect. We are getting completed by the end of 2027, so there's no risk. The second situation is if we are going to rely on the beginning of construction test that was safe harbored before the transfer took place. So that's kind of the scenario I just laid out. Owner number one starts construction and then transfers the property, transfers the project after July 4th to a new owner. We now have to rely on this beginning of construction date that was established before the transfer happened. There is some risk in that, but like I said, it's a much lower risk if you can transfer the entity. So if you think this is a possibility, you'll want to create an LLC or some type of a special purpose entity. That entity is going to own the project. And then when you sell the entity in full to the new owner, that preserves the start of construction date. Option number three is post-transfer. So we're kind of getting beyond where this is a scenario. But if January 1st of this year you started construction, and then sometime before July 4th, you transfer the property, or you transfer the project, or you transfer the entity before July 4th, and the new owner takes ownership of it before July 4th and then takes it to completion, well, it doesn't really matter because you've got a start date of January 1 that you could rely on, but the new owner took over and established a new start of construction date before July 4th anyway. So that start of construction was established post transfer, and there's no risk in that either. And you would have your 4 years to complete and still be pretty safe. So the thing to highlight though is, let's not get into transferring panels and transferring inverters and transferring racking systems individually as property. Let's transfer the special purpose entity all in one big chunk to try to preserve this start of construction date. We've got one more slide and then we'll take some questions. So, kind of to reiterate everything that we've said, key deadlines for what we're looking at: July 4th, skipping the first line. July 4th is our first big deadline. We've got to start construction by then. If we have any concerns about not getting done by the end of 2027. However, if we miss our July 4th start of construction date, we do have until the end of 2027 to get completed. So that'll be your next deadline to meet. John, what's some of our best practices that we need to pay attention to?
Sure. And again, this is important to keep in mind because now this is where the rubber meets the road. Think of it when you go to your CPA at the end of the year and give them that shoebox of tax receipts and such. You don't want to be doing this after the fact, especially several years down the road. It could be a nightmare. You want to do this contemporaneously as possible. You want to have good records, good documents, time stamped, time dated. Ideally, you'll have photographs on site. You can use drone technology and film some of this. Create your facts and circumstances bundle because there's a lot of money on the table. These are not to pare down your credit, reduce the rate, anything like that. This is a cliff. And keeping that in mind, understanding the importance of complying with these rules is could mean a total disqualification of your credit. So we want to leave you with that thought, how important this is. It's not just administrative, not just bookkeeping, but this is some very impactful things. And Josh, I don't know about you, I'm sure, but I enjoyed sharing some of this with our audience today, and looking forward to some good questions.
Absolutely.
So I'll jump in here. There's lots of questions we've had coming through. I'm just gonna fire them at you guys, and you guys can take them as you want. So the first question is just to confirm: would the OBBBA sub bullet point mean that a solar system would need to be placed in service before December 31st, 2027? I always heard the July 5th deadline was critical. So just learning now additional pathways to be eligible. So I think that question got answered throughout the presentation, but
Yep.
if you want to
I
dig.
mean, yeah, we can rehash it, but yeah, it's an either or situation. So you either get started before July 4th or you get finished by the end of 2027. It's not both.
Yeah. This is another early question. This is what does the start of construction mean for ITC? Is the deposit the start of construction? It's kind of open-ended, and we got dove into that pretty
Yeah.
deeply.
And yeah, if you have a
It's
specific situation, I'll just add, if we didn't cover your situation, because there are a lot of complicated situations out there, feel free to shoot us an email, engage us in some way. We're happy to give you some high level information, and then if you want to dig deeper, we can talk about really like diving into your project and making sure that your start of construction is protected. So.
Um, Next question is like, do we have an on-site example for like a rooftop solar? I would assume it's a start of construction example.
Sure. That's simply engaging with the installer, getting a contract signed up, purchasing materials, uh, getting on and starting to do some of the pre-installation work, ordering the racks, things like that. More than just having someone come out, do an estimate. Those kind of things won't count, but the actual affecting of the installation, those kind of things count.
Yeah. Next question, I says for roof-mounted solar, does the building foundations qualify as work of significant nature, or is the racking on the roof the minimum structure for the roof-mounted solar? So
Yeah, that's
this
a good
question is
question.
coming from a new construction point of view.
Yeah, it's a good question. So we're looking for the solar property to be started construction. So yeah, starting foundation on the building itself is not going to qualify you for starting construction on the solar project.
Yeah.
So that's a really good question.
Yeah, it's funny because I know exactly what project he's talking about. We just
Yeah.
had a call on it the other day. Um,
Great
so
question.
after safe harboring with the 5% rule, are there any restrictions on making changes to the size of the project, price and KW, either up or down, that would jeopardize the customer from receiving the tax credit? I thought I'd heard about 20% or greater restriction for changes to the project size after safe harboring.
That's a
There
good
are
question.
issues that can come up if you're looking to uh, potentially relocate a project where it's not in the where, for instance, you're looking to transfer it perhaps, and there are some things you can do. I might be thinking about a relocation, but I know that you're clear there. If there are very minor changes, meaning just redirecting the panels to get better reflectivity or something. And I don't remember, Josh, if I'm talking about uh, there was an issue where you would have the ability to make minor changes, and that you were limited to make minor changes and still qualify for your beginning of construction. I'm not grasping exactly what it was,
Yeah,
but as a
I don't.
rule, your relocations, you're going to be allowed to do them.
Yeah, I don't see any concerns really. I mean, obviously, if you
Yeah.
we kind of covered it a little bit, so it depends on how you started construction. So again, it's the you got the physical work test, which is work of a significant nature, right? So if your project materially goes up in size, did you do enough at the beginning to materially start construction on this now larger project? Was it significant enough? So that's where the subjectivity of the physical work test comes in. The 5% safe harbor, that's an easy one. So this is where we say you want to put down more than 5% in the beginning, because if this was to happen, if your project was to go up 50%, well, now you needed to have put 50% more down in the beginning. So you want to overestimate this to kind of catch those things in to where if when you do materially change the size of the project down the road, your safe harbor is protected at the beginning. The only other caveat I'll mention is we didn't get into it today, but prevailing wage and apprenticeship requirements. If you, I think, and maybe this is where John, you were going with it a little bit, but if you're if you're if you're needing to require if you're needing to meet the requirements of prevailing wage and apprenticeship, you're under prevailing wage rates that were established at the beginning of construction. Now, when you materially change the size of the project, you are reestablishing new prevailing wage rates at that point. So you have to now change your prevailing wage rates because you have a material change in the size and the scope of your project. So there's some caveats there. So you definitely got to be careful when your project changes size by a significant amount.
Thank you, Josh. That was it. It had an implication, but it didn't relate to the beginning of construction. It was the PWA rules. Thank you.
Yep.
Another question is, would there be an excusable delays if you were to miss the safe harbor deadline and had to complete by December 31st, 2027? So I'm not
No
sure.
excuses.
Yeah.
Yeah, no, that's a cliff.
Yeah,
You,
you gotta be done by 2020. If you miss both deadlines, if you miss July 4th start of construction and you miss the 2027 completion, you're there's no caveats to get an excuse for missing either of those. So you're
you,
going to be in trouble.
you'd have to start lobbying Congress and hope that something happens with legislation on the back end.
That's
So,
right.
yeah.
Yeah. Yeah, but and I think maybe that question we could answer another question maybe that's in there. There are excuses, right, for not meeting domestic content, for instance, where the domestic content was too expensive, and so you had to source non-domestically and things of that nature. So there are excuses for things like domestic content, and but for start of construction and completion of construction, there's no excuses.
Yep. Couple more questions, and we're coming up on time here. It says, so when transferring the project, does the project have to remain at the original location, or can the project change location in addition to entity owners?
Ooh.
Yeah,
Yeah.
I think, go ahead, Josh. Yeah, yep, it's a stacking issue.
It is.
Yeah.
Yeah, I mean, I think that's getting risky. Obviously, the safe scenario is you've got a big piece of land and this part over here on this piece wasn't a good site, so you moved it on the same piece of property but to a different location. That's a pretty safe move because you're same ownership of the land. The second bump up would be I'm moving it to a different piece of property, but it's owned by the same entity. So the off taker is the same owner, same taxpayer. So we're moving it from one piece of property that I own to another one, but I'm still the same beneficiary and I'm still the same recipient of the tax credit. And then, kind of like the caveat that sounded like it got introduced, is we're going to move it from this property to that property, and we're also going to change taxpayers at the same time. And that's going to get real dicey. Um, that's going to be something you'll want to engage us on to really dig into that one because I'm okay with transferring ownership from but transferring owner and location at the same time sure kind of sounds like a whole new project.
It's a stacking issue for sure. Timing is
Yeah.
important, all of the execution of your documents, but that's right. I'm with you on that, Josh. That's the approach I think to take.
All right. Another question. It says, do you need PTO or substantial completion by 12/31/27?
Placed in service.
Yeah, John, do you want to jump in what placed in service kind of means from a tax perspective? Because a lot of
Sure,
people,
yep.
PTO is a nice way to substantiate it, but it's not the
Yeah.
end all be all.
So I'm glad you mentioned that, David, because here's the thing. This is going to be the next big thing. And I got
Yeah.
this from folks. I was at a conference a couple of weeks ago. Once we get to 12/31/27, there is going to be a scramble for all the folks who believe they might have hit the 7/4/26 rule, but might not have. And so there's going to be a revisiting of all of this beginning of construction, even that far away. And so the issue is going to be what does placed in service mean? And the scrutiny that's expected is going to be higher than present scrutiny for those reasons. So these are things like is the all the permitting been done? Are we generating power? Are we using the facility? Are the interconnects completed? There are a set of factors we look at. There's not a sum or an absolute answer. These are called the Oglethorpe power factors. And we look at these 5 factors, and it's a facts and circumstances analysis. And so you see the potential for having a problem on 12/31/27 if the beginning of construction rules are not met. That means 12/31/27 is going to have more consequence than otherwise. And so those are the kind of things we could help you with too between now and then, because that is again part of our services in providing this kind of assurance.
Gotcha. And one very last question, I know we're over time, says you did say anticipated inflated related cost increases, question mark. Can relocation and new site preparation charges be included later? I presume it's a no.
I'm not sure I understand that one.
Um, okay. I think they're talking about new site. Well, I guess they're talking about the relocation piece of it. But you can
Yeah.
get with us offline. Same thing, Bill. You asked here. We're gonna jump off here, but feel free to shoot us an email. We can get with you offline on those specific factors with John. All right. Thanks everybody. Looking forward to helping out you all with these projects, and good luck as you get to safe harboring. So appreciate it.
Yep. Thank you.